Hello, it's Tim Moffat here from Oakleigh Investment Management. I'm again sitting with Akhil Patel, who is an investment committee member, also a director and founder of Property Share Market Economics. We're just finished off the September quarter. We're going to give another little video update just in terms of what's been happening in and around the 18.6 strategic portfolio, how we landed at the end of the quarter and how we're seeing things towards the end of the year and into 2026. So as usual, I'll kick it off. So end of the quarter, the portfolio, look, to be honest, about halfway through the quarter, I was looking at things thinking, geez, it'll be really nice if we can deliver a 10% return, which fortunately by the end was a half. We actually ticked over 20% for the quarter versus the MSCI World Index, which sat at about plus 6.5, which was slightly higher than the All Ords. So we're now looking at about a 40-odd+% over the rolling 12 months. That's more than double the benchmark. So we certainly had an extremely strong quarter. And now behind that, we really start to see the sectors that we'd been positioned in run and trend very hard. Precious metals were a big contributor to that, and certainly, well, the biggest contributor to that. But we also saw positive momentum in the copper holdings and also the banking and financials. A little bit more mixed. They'd been stronger early in the year, but that and a little bit from emerging markets certainly drove strong momentum across the portfolio in the quarter. And look, adding to some of the performance is the active management. So we exited a handful of underperformers, and we've been letting our winners run as much as we can. Now, that performance is obviously quite strong. We just wanted to stress that we've done that with a high degree of risk control and risk management. We haven't got any highly speculative stocks in there, and we have been focused really heavily throughout the whole 4+ years that we've been running this portfolio on capital preservation. And just to kind of highlight that, like our smallest two holdings, their average market cap's over $3 billion. Our largest ETF has a portfolio weight of under 10%, and that's only because it's run very, very strongly. Our largest stock weight has a exposure of 7%, but we only invested 4.2% of the capital in early July, and it's just run incredibly hard. So, we're not taking huge position sizes, and we're certainly not investing in the micro end of the market. And just to sort of show that through the last 4 years since we've been running the portfolio, our max drawdown, so from the highest level the portfolio's got to the lowest level, was -15%, whereas the MSCI World Index was over 30%. And for the financial guys watching, the portfolio has been running of a beta of 0.5. So in finance world, that's a measure of the portfolio's volatility versus the global market. So 0.5 is effectively half of the volatility of the global market. So, just some good numbers there to show that the risk and the risk management has been certainly also adding to certainly our risk-adjusted returns. In terms of the quarter, top contributors, Linus was a new addition. We added that in the end of June and then added some more early July. That's run incredibly hard in the rare earth space. And then you're going to see a handful of gold stocks. So we've got a global gold miners ETF that was up 50%. Capricorn Metals was up nearly 40%. Newmont mining up 38%. And then also we had the global X copper miners ETF that was up 30-odd%. So things obviously been pretty strong, certainly in the mining space and the precious metal space. Obviously, the gold hitting all-time highs is starting to get a bit of mainstream press and hitting the front pages of the news quite a bit. So that's just something to be mindful of. In terms of the outlook, look, we still expect continued upside over the next 3 and look possibly into 2026, but certainly caution is rising. As asset prices and share markets climb, the risk of downside is increasing effectively with that from here. So the strategy is very much keep capturing the upside through 2025 and tightening our risk management and risk controls, preparing for what we expect is more volatility in the years ahead. We've got effectively trailing stop losses on all our holdings now, including our core positions. So when stocks start to misbehave, even if they're super blue chip, then we're willing to act and return to cash as needed. So we did end up in the quarter with about 11% cash ready for some tactical deployment. But we certainly haven't built those cash levels up too aggressively yet. If this market keeps behaving in this manner and works its way higher into the end of the year, then potentially those cash levels will start to rise as a bit of a defensive and capital preservation strategy. So there's the, I guess, the overview for the quarter and where we stand. How are you seeing things from an economic perspective, Akil, or do you have anything to add in terms of outlook?
Yeah, I mean, it's been a really interesting quarter in terms of the portfolio. It's been great performance, really good performance for the last 12 months, as you've outlined. The economic news, I think, has not been quite so positive, but I mean, this is not unexpected at this point in the cycle. The economy is actually getting weaker, while the markets are kind of rushing into all-time highs. We know kind of very clearly from past cycles that commodities, in particular precious metals and in some industrial metals, are likely to run very hard into the peak of the cycle. This is because there's a global kind of construction boom. There's a lot of competition for supplies. If we've had coming out of a period of relatively low prices, there's been underinvestment. So there's restriction in supply, which drives price high, meeting this sort of renewed demand. We're seeing all of that sort of thing. Very pleased that our portfolio was positioned quite early on to take advantage of these relatively large moves, because we really have invested in line with the cycle. Now, I think you're right to have a relatively cautious stance going into the fourth quarter into next year. What I am seeing in markets in general is perhaps a greater sensitivity to certain types of news. So I think there are some relatively large players that are maybe also managing their sort of positions and their risks in a way that we are. And I think that we're not really that far off potentially the peak of the cycle. Doesn't mean that we'll necessarily get straight away a recession. But it does warrant us to be relatively cautious and to focus on capital preservation to lock in the gains that we've had. Of course, I mean, there will be opportunities even then, and we'll take advantage of them if they seem appropriate. But the caution is warranted. I think there's probably two main things that I'd focus on. The first is that the US is I mean, it's slowing down. The labour market is starting to weaken. The housing market, while the signals are a bit mixed, I think is also weakening. You're seeing that reflected in sort of construction stocks, home builders. I mean, they might have had a bit of a recovery, but I don't think they're looking in great shape. And some of the Australian listed stocks that are exposed to that are reflecting that kind of concern. I think the second thing is that we haven't really seen the full effects of the slightly volatile economic policy coming out of the US. Some of it may well have been propped up by strong government spending, deficit spending, and so on. That is under pressure. Potentially, there's a shutdown lasting who knows how long. That will have an effect on GDP. I think that will potentially have a knock-on effect on other things. And so while markets are rising quite rapidly in some cases, and obviously we'll take advantage of that, I think there are signs that things are looking a bit sort of ropey in places, and we have to be mindful of that and adjust our risk management approach accordingly.
Yeah. Okay. Well, let's just see how this quarter unfolds. We'll continue to do our thing, but I think you're right. There's certainly a few red flags popping up around the place and a few signs of, I wouldn't say trouble at this point, but certainly the positive momentum seems to be slowing. So, that is what we'd expect to be seeing right now, but we know that the market can continue higher after that turn in the economy, sometimes for a number of years. So it's just about capturing as much of the upside while it's around as possible, and just keep focusing on capital preservation as much as we can.
Absolutely. I mean, I just sort of to highlight, I think it's really the stance that we're taking and we should take is to adjust our approach to risk management, not to, of course, exit the markets. Because, I mean, history does show that when you get to the peak of the cycle, stock markets can continue to rise even beyond that, as they have in some previous cycles. So we will certainly want to capture the upside going forward. But you need to know what's going on, what's really going on beneath the surface to be able to do that effectively.
Yeah, beautiful. All right, that's fantastic. For anyone who's not an investor and interested in being an investor, you can either email us at invest@oakleighfs.com, or you can find us on our website. We have a page around the 18.6 strategic investment portfolio, and on that page there's a button to put an inquiry to invest, and someone will contact you to give you some more information. Thank you very much for your time, Akil. I will speak to you again in 6 to 12 weeks. Potentially we'll do one before the end of the year, just to give everyone to see what's going on in markets, and touch base then.
Brilliant. Thank you very much.
Thanks. Bye.